Thanks so much for joining me.
Appreciate the opportunity to be here.
Well, in the past, when you came on with Doc, we were talking about sports, and you're likely known for that, though your roots obviously are deeper in private equity. And would just love to give a little color on what brought you to thinking about the private equity industry.
I started my career as a limited partner. I worked at a fund of funds platform. And so I know what it's like to meet with 5 managers a day, to hear the pitch, to get jammed on a co-invest timeline. But that experience as a limited partner early in my career gave me a real appreciation for the client, for the market's needs from a client perspective. And my entire adult life, I've been very entrepreneurial. And I started a business with some colleagues that was the very first intermediary helping limited partners sell in the secondaries market. That firm was called Cogent Partners. And being one of the founders of a business that really changed the cost of capital for limited partners forever was an incredible opportunity for me and the rest of the founders. And it was a springboard for me into a career of serving this asset class, LPs, GPs, and all of its stakeholders. And that kind of servant leadership mentality has really been a part of my entire career. So I come into this new firm that we started 5 years ago, having served the leaders of other private equity firms, limited partners, and being an innovator in the market my entire career. So that's my background.
I'd love to dive into what you're seeing in that GP LP landscape. Maybe we start on the GP side. The nature of an investment manager, private markets today, is totally different from what it was when you started. So as you're talking to GPs, what are you hearing are kind of the most important needs and challenges they're facing?
If you take a step back, I don't think most market participants appreciate or understand how complex these businesses are. The management company, the GP, that is a complex business. And as the firms grow and mature, that complexity increases in non-linear ways. These are challenging businesses. But the leaders of these businesses, they typically are great investors, but they're also entrepreneurs. And that entrepreneurial journey is particularly lonely in this industry. It's a lonely gig. And so our team's job, the thing that I love, is serving the entrepreneur on that journey. The way that we do that is powered by data and some really cool tools to break down the market, to break down firms, and the competitive landscape in particular strategies. That's what we bring to these conversations. But it's funny, when you go talk to a GP, they are so hyper-focused on their business, on their strategy, on their team. Very rarely do they have a perspective on the broader market, because they tend to pop their head up every 3 or 4 years and go ask for money. They're not in the market data with a pulse on the market every quarter, every week. That's just not their job. And we have some really powerful tools to measure sentiment. It's actually called semantic mathematics or linguistic kind of mathematical narratives. And you can actually measure what matters if you have the right tools and the right information to do that. And that's part of what we do every quarter. We call them our now narratives, where we can mathematically summarize the things that GPs care about right now and the things that LPs care about right now. And we actually push those out every quarter to the leaders of this asset class so that they have a good pulse on these are the things that everybody knows, to use our friend Ben Hunt's language.
So in your most recent now narrative, let's just start on the GP side. What are those most topical narratives in the market today?
I'll tell you what's topical now, but then we should also talk about how these change, because they change pretty quick. And it's fun to talk about why they're changing, right? So the now narratives for Q1, which we're about to publish, are the election's impact on M&A and animal spirits. It's the consolidation and M&A of managers with other managers, just M&A within Sponsorland. It is the challenges of the fundraising environment. And new is a particular spike in people talking about their value-added capabilities. That hasn't been in the now narratives in a while, but it's very thematic now. We think it's because it's time to do deals. The cost of leverage is kind of prohibitive. Pricing's kind of prohibitive. So you've got to craft a narrative about how you can do great deals while still buying at full prices with very expensive leverage.
And how those changes that they can change quickly, how does that play out in the data analysis assessment?
Well, you actually see the themes in the semantic summary of all of the coverage, all of the discussions that are in the market, even public alt managers, analyst calls, all of the articles that are written and the quotes that are given about, the private equity industry by the leaders of this industry. We have these very large language models that just read everything, and they measure the sentiment, they measure the themes, the interconnectedness of the themes, and then you get these narrative casts that help you understand the language that matters right now for a particular kind of audience.
So what do you do? Or you could summarize this, and I don't know that there's anything that you said that isn't top of mind. As you said, it's what we know that everyone knows. How do you then discuss that with a GP that has their heads into just their own strategy?
What we do every quarter is we take those themes that matter, and then we break down the data behind why they matter. Why are these the 4 or 5 most topical things that the leaders in this industry are talking about? What is the data behind the importance of this trend? Where is the market going from a data perspective? And so we bring all of this machinery and data-driven perspective to the conversations with the leaders of other firms to help them understand where the market is going and why. That's very powerful in and of itself. But then we also have a completely different set of software and tools to help firms understand their own capabilities, their competitive landscape, their right to win, their alpha generation, and tie all of those things into how can your firm be successful, however you define that, given the changes in the market that are taking place right now. So it's this holistic perspective on the market, but also applying that to each firm uniquely based on their capabilities, their skills, their goals.
And as you go through each of those now topics, you can take one at a time, that sort of M&A, elections, and deal activity. What's the narrative around why that's happening? I mean, some of that sounds obvious, right? It's got the elections. There's some belief that deal activity is going to come back.
Yeah, there's this animal spirit around the election results, the new administration, deregulation, and you can see that animal spirit in the price change of publicly traded alts managers, strategic advisory firms. Like their share prices have moved in non-market ways, reflecting that animal spirit. Whether that manifests itself into actual deal activity, to be determined, and probably something we'll talk about a little bit later. Manager consolidation and M&A is a theme that has been emerging and dominant for the last couple of years, but it is a byproduct or an emergent trend from several themes that are happening under the surface within this asset class around fundraising, product proliferation, insurance, wealth. All of those sub-themes are driving M&A and consolidation. And we have a whole framework to break down firms that look similarly from an organizational complexity perspective that allows you to understand why certain M&A is taking place and anticipate moves on the chessboard for some of the bigger consolidators, what we call level 9 and level 10 firms.
Well, let's dive into that framework. So you mentioned this framework for figuring out where these different firms are in this landscape. What is that framework, and how did you design it?
It's designed to look like a pyramid, where at the very top are the most complex, the largest, the most sophisticated firms. We call them level 10s. All the way at the bottom, at the base of that pyramid, the level 1s, those are startups, zombies. They're micro firms, basically two people and a dog. We track 6,000 private equity firms, predominantly in the US and Europe, who have raised institutional capital in the last 7 years. It's about 6,500 of them. And each firm is put into one of 10 levels that are defined by the size of the firm, the breadth of their product mix, the number of asset classes that they serve, the types of products that they offer, their own firm capabilities. Are they local or are they global? Do they have a public stock as a currency? Do they have their own balance sheet, their own wealth distribution capabilities? Do they own a captive insurance business? And what's interesting is if you organize the industry based on these 10 levels, changes in the market impact firms that share a level a lot more than firms that share the same strategy. And that's pretty unique. A level 8 infrastructure firm and a level 8 buyout firm are impacted by the market in more similar ways than a level 2 and a level 8 infrastructure firm. And this framework allows us to help managers understand why things are happening to their organization, why things are happening to their competitive landscape, and what are the changes they need to make organizationally to achieve their objectives. So if you just take like one level, at the very top, there's only 6 firms at level 10, and they are enormous. They look more like Goldman Sachs than they look like Arctos, right? It is Ares, Apollo, Blackstone, KKR, right? It's the biggest of the big. Level 9, there's only 10 or 11 firms, and they're typically missing one thing. Maybe they don't own an insurance business, or they're not in credit yet. But each level 9 firm, in their own language, is trying to figure out how to close the gap with the level 10s. They're thinking about their product portfolio. They're thinking about how to sell product that they don't have today. 95% of the level 9 and level 10s are publicly traded. And you can anticipate the moves they're going to make based on the gaps that they have to go from level 9 to level 10. But those 15 firms, which is 0.2% of the universe that we track, 0.2% of the universe controls about 20% of the AUM. If you go down just 2 more rungs, go level 7 to level 10, those 700 firms control 90% of the capital. It's crazy. There's this massive power law of capital concentration within the asset class that I think most investors are aware of. They don't appreciate how strong that power law is.
As you're talking to GPs about this framework, how do you think about the importance of what their goals are? Are they seeking to move? Is the goal to move up the pyramid? Is it to make sure you don't fall down the pyramid? Like how does that change based on where you sit in the pyramid?
Managing partners tend to be hyper competitive. So when you tell one of them they're a level 5, they want to gamify why and how do I get this? It's like, well, hold on a second. Where are you actually trying to take this firm and why? Because a level 5 firm is typically single strategy, best in class manager. They are very, very good at what they do. They're very content to just stay where they are and come back to the market every 2 to 4 years and just keep doing it. If you want to stay a level 5 firm, because of changes in the market, you have to put energy into managing that business to maintain your level 5 place. The market is changing and the client is changing and the competitive landscape is changing in ways that require you to level up your firm's capabilities, even if you just want to stay where you are. And that's a big shift that's taken place over the last 4 or 5 years. As this market has matured, the quality of talent that is required to just stay where you are is significant. If you want to grow, which is kind of what leveling up implies, I said it earlier, the organizational complexity is nonlinear. The capital that is required to grow is significant. And depending on how you grow and where you grow your organization, one of the things that we challenge you on is, do you have a right to win in the direction that you're going? Do you have the skills in the 6 or 7 areas that we think are critical for these businesses? Do you have the skills and capabilities as a firm or within your talent pool to compete where you're heading? And that's part of our process and part of the keystone value add to these managers is helping break down their organization, their capabilities, and doing that against their historical alpha generation and the competitive landscape of where they think they want to head. But it's a powerful framework. Like you said it, why they're going there is very important. We were talking to the head of distribution for a great firm. And I was walking him through this framework and he said, oh my gosh, I wish I had seen something like this 6, 7 years ago. Because for us, it was all about going from level 6 to level 8, but no one knew why. And he said, we lost ourselves on the way to level 8. We lost the thing that made us special. And so one of the things that we try to do is challenge the leaders of these firms on what is your vision, but as important, why is that your vision?
When you look at a firm that, say, wants to go from level 6 to level 8, and you have these, say, 5 or 6 different features, characteristics of the firm where they need to succeed in all of them, how do you diagnose? Maybe it's data, or is it all just qualitative of where they have a right to win?
So we have what we believe is one of the most sophisticated software platforms for isolating and estimating alpha generation for the manager. It's a service that we provide to the manager, and it's a collaboration with them. They give us very detailed data because they're about to make big strategic and talent decisions, and they want to have the best possible data to drive some of those decisions. So we have this very clean data that goes through a proprietary process for diagnosing skill versus luck, and then breaking that down across every strata that matters: industry, deal partner, size strata, geography, product. And as you start to disaggregate performance, you can start to identify where in the process that came from. First of all, have you generated enough alpha to justify taking illiquidity from the client? A lot of firms, the answer is no, especially net of fee and carry. But for those where it is significantly positive, where is it coming from? Do you buy really well? Do you exit really well? Do you pay full or high prices, but create massive change within the organization while you own it? We can measure those things, and that gives you clues as to where the skill within the organization is different from the competitive landscape. And you know, I'm not a huge sports fan, but the Arctos brand started in sports, and I've learned there's actually tons of similarities between the sports industry and the asset management industry. The higher the skill level in a competitive game, the more luck determines the outcome. If you took a average Major League Baseball player today and put them into the game in the 1950s, they'd be a Hall of Famer. The skill level is just so high today, right? The same is true in asset management, and the same is true as you move up in levels. The more competitive the game, the higher the skills are required to compete. But the higher the skill level, the more luck comes into play. And we have tools to like disaggregate that and measure it for GPs that are really powerful. And with this data, you can then help them gut check if the moves they're about to make, if the changes that they want to implement are supported by the data or not.
Curious how your conversations with GPs at different ranges of levels in the pyramid change. So, for example, the big guys, level 9, level 10, probably not that hard as you articulated. There may be a gap in their portfolio, but they're trying to do everything. You can envision it's quite different in the mid-market. And would love to hear your thoughts of the various mid-market. I don't know if that's level 7 to 4 or however you define it, of the various different types of conversations you have based on sharing this framework and the analytical tools to help them understand where they have a right to win.
One of the themes that we've talked about with our investors is we are in a scale matters environment. It's kind of a winner-take-all phase. And one of the things that I've been talking to our investors about is that the rules of the game that you've been playing, tear them up. All of the work we've all done using the last 20 years of data, all the things we learned, I'm not sure that game's being played anymore. There is a new game that the 15 biggest firms in the world are playing. And the wake of chaos that they're leaving behind them is the new game everybody else is riding. And I'll give you some data just to like frame this up, right? Last year, the 6 biggest LPs in North America committed about $55 billion to funds. Huge number. The 6 biggest private banking and wirehouse platforms last year, just to funds, committed about $110 billion to funds. It's 2x the number. In the last 12 months, the level 10 firms in our framework, just in the last 12 months, have raised $250 billion from insurance companies they control or through the wealth channel with sales forces that are theirs. There is a capital aggregation theme for the biggest firms in the world that is creating a completely different experience for them. I think Rowan talks about this. They don't have a capital origination problem. They have a deal origination problem. That is the world of the level 9, level 10 firms. For everybody else, capital is constrained. There is a, for lack of a better word, maturity wall coming in 25 and 26 for a ton of firms who've been able to kind of bootstrap it and scrape through the last 3 or 4 years. But there's a reckoning that's coming. Understanding the rules of the new game is really important for both LPs and GPs. What are the incentives that drive the decision-making? That touches so much, so many of the assumptions in allocation models and underwriting models. And we're trying to build some tools to help our clients and the GP community understand those changes real time.
As you see this reckoning coming, there's a subset of the existing GPs that are going to struggle in that environment. What do you think happens with the talent at those firms if, let's say, they're unable to raise a successor fund?
Everyone wants to go back and find the thing that looks like the new thing and draw comparisons. There's nothing like what you're describing. After the GFC, there was this wave of firms that got labeled zombie firms. They hadn't raised any money, weren't going to earn carry, lots of value trapped. That's not what we're talking about here. There is tremendous unrealized value and unrealized gain managed by really talented people And the firms that they're a part of are going to come to market in the next 12 to 24 months, and they will not achieve the fundraising target that they need to feed all of the ambition and the mouths at that organization. That's not a zombie. I don't know what happens to those firms. We're trying to help some of them figure that out right now. There's lots of paths those firms can take, but they're not zombies. They're almost penguins on a melting block of ice. You don't know how fast it's melting. It might not even be melting, and you can just sit and wait it out. You can jump off and go find your way back to land or a bigger block of ice. But helping these firms prepare for this challenge, make sure that they're clearly articulating their right to win, making sure that they have the skill and talent in every area that matters that is required to compete for whatever capital is available. That's what we're focused on. And I think those firms have a shot to go through this kind of phase change, this evolutionary change that's happening as the market matures. It's just not going to look the way that it did. People keep asking me, when's it going to get back to normal? When is it going to be it ain't going to be like that. It's never like that. Right? The market's just changing.
Let's turn to what you're seeing from the LP's perspective and maybe go back to the narratives that are most popular for LPs.
The dominant narratives for LPs right now are all around liquidity and constraint, or changes in the market that might be eroding traditional LP control over this market. Those are the two kind of dominant threats. So the lack of liquidity and the lack of exits and what that does to the fundraising environment, that's a big theme in the LP land, but like continuation vehicles in the secondaries market and things like that hang from that. The growth of wealth and permanent capital and private credit away from the traditional LP GP architecture, that is something that is starting to become dominant in the language that LPs are using. And then consolidation of relationships, focusing on re-ups, doing more with fewer, which is a derivative of, or it's caused by, the lack of liquidity and the slowdown in fundraising. But there's a feedback loop or kind of a reflexivity component. These are why consolidation is happening on the GP side. Right? They're all interconnected. But those are the dominant themes from the LP's perspective. And some of our tools help LPs understand changes in the distribution environment, in the cash flow environment, and how that might impact their allocation model. So we can double click into that stuff too, if you want to.
Yeah, no, I'd love to jump in there, which is from an LP's perspective, exits have been slow over the last couple of years. Deal activities have been a little slower. How do the tools you've developed help an LP think about their cadence of investing?
We have tools that pretty accurately forecast distribution yield. So this is cash coming off of your NAV. Contribution yield. So this is sort of the drawdown on your unfunded balance. And then the resulting net cash flow profile of the asset class, right? One of the questions we get a lot is, will the deregulation and the animal spirits and all of the focus on exits, will that unlock an exit boom? You have to use very precise language when you talk about distributions, because what actually matters to the LP is not the dollar value of distribution. It's the distributions relative to their unrealized book. That yield is actually the important thing. And the yield of private equity today is as bad as it's ever been. You're talking about depths of the GFC. You're in the bottom quintile of distribution yield right now. But over the last 10 years, dollar distributions have been pretty consistent out of North American buyout of about 40 billion a quarter. There's only one exception. It's kind of like the 2020, 2021 bulge up. Very consistent for almost a decade. $40 billion of distributions every quarter. 10 years ago, there was about 20 billion of drawdowns a quarter. So you had this really nice net cash flow yield. But over the last decade, while distributions have been very consistent at 40 a quarter, drawdowns have doubled to 40, right? And NAV has tripled in the last 5 years. So the yield has just nosedived. If the distribution yield, which today is right around kind of the bottom quintile, if it just moved its way up to the worst quartile ever, it would be the second biggest year for exits ever, dollar-wise. That's the challenge. If you just get an average yield on all of the accumulated NAV, this year would be the biggest exit year ever, and it would exceed the best year ever by about 20-25% in dollar volume of exits. And that's the challenge, because unless the asset class flips to a cash generative piece of the portfolio, it will not change the fundraising environment for all but the biggest firms in the world. Does that make sense?
It does. There's two countervailing factors. I'm curious to get your opinion of how they shake out. So on the one hand, as you said, the asset values tripled, but the distribution, the gross distributions have been about the same. So the distribution yield has gone down. And maybe that's because they're newer or deal activity is slower. On the other hand, you look at it and say, wait a minute, if there's 3 times the asset value, what is it that's preventing 3 times the distributions? And you put those two things together, right? Maybe you haven't had the most favorable environment. Do you think that's something, or let me just ask it differently. Like, why do you think that that's happened, and where do you think it goes from here?
So before I tell you why we think it's happened, let me explain why it's actually worse than what you and I just talked about. Okay? Distribution yield is very low, but that includes what I think the market now calls inorganic distributions. Distributions from continuation vehicles, NAV loans, and all this other activity. By our estimate, between 15 and 20% of all the exit activity the last 2 years has come from inorganic transactions. So if you just talk about the distributions that powered the models and assumptions that most investors use today, IPOs, M&A, sponsor to sponsor, the yield from those traditional exits is actually even worse than what you and I have talked about, right? So why is that? We think there are 4 important ingredients to the equation on how you get yield back to normal. The first is you need an accommodating macro environment. And all of the tools that we use and we think matter suggest you are in as good an economic environment as this asset class has ever seen. The U.S. economy is growing. Everybody knows that growth is attractive. It's the most attractive risk-reward proposition in the world today, the U.S. economy. We call it the Goldilocks zone, where you have strong growth and high confidence in that growth. Over the last 25 years, when you're in this kind of market environment, the distribution yield is typically top quartile, and private equity is typically undervalued relative to public equity by about 10 to 20%. Both of those are not true today. So the second part of that equation, the first part is macro environment, and it's flashing green. The second part is around intrinsic value. If private equity is not cheap relative to public equity, it is hard for the IPO environment or M&A to get excited.
Sure.
We have some powerful tools that measure the intrinsic value of private equity relative to public equity. And today, they suggest that private equity is overvalued by about 10%. That's a lot better than being overvalued by about 40%, which is what those tools said 2022 looked like. So you're slowly closing that gap, but you are still overvalued. And that makes it really hard for a big part of the exit channel to be very excited. Right? There's not a mutual zone of acceptance, is the Wharton word for what I'm talking about. The third part of the equation is the spread between the entry price implied return on asset and the cost of leverage. LBO is buying an asset and levering it and holding the equity. Prices today at a macro level, public equity, and micro private equity, entry prices have never been this high. You're in the 90th percentile plus in every valuation metric that matters for US public equities. And entry multiples in private equity have never been this high. And holding multiples have rarely been this high. Entry price matters. You invert the entry price, your return on asset is pretty low, historically quite low. And that is a challenge that can be overcome if debt is very cheap. But it's not very cheap today. Spreads have compressed, which is a whole nother topic. But the cost of an LBO financing, especially compared to the last 10 to 15 years, is above average. So you have an above average cost of debt, you have a below average return on asset, and that creates an ROE kind of carry trade that's not accretive. And that matters for sponsor trades. The fourth part of the equation on how you get back to a normal distribution yield is incentives and alignment. And that when I talk about the changing rules of the game, that's an important part of this equation, an important part of this puzzle. And we think the new rules that have been set over the last 4 to 5 years are creating a framework where sponsors are reluctant to sell to each other. And when they can, using a CV type transaction to hold on to an asset, to grow their fee-related earnings, and in effect create inorganic AUM growth, is a powerful incentive, especially when you're not sure the old rules apply, where if I deliver a great exit to my LPs, they're going to round trip some of that money and support me on the next fundraise. People don't trust that game anymore, because if the LP is over-allocated, they're over-allocated. And if the LP is trying to do more with fewer, they're trying to do more with fewer. And so if you're a middle market GP who's worried about this fundraising environment, and you can CV an asset, grow your revenue streams, create a new carry pool for your team to keep feeding the talent that you're responsible for, and live to fight another day, that's a powerful incentive. It may make you reluctant to sell to another sponsor. And the other thing that's kind of interesting is the old rules, sponsors left a little bit of juice in the deal for the next guy, right? They helped create the growth plan for the asset. It was part of the pitch, right? You buy this thing, here's how you unlock the next 5 years. So it would go, so some of these companies would just trade to sponsors for a decade, right? Well, now if I'm a sponsor and I'm getting a book from another sponsor and they're not CVing it, I'm a little suspicious. Like, what am I missing here, right? So things are changing in ways that are not captured by old data sets, the old incentive mechanisms. And I'm not saying it's good or bad, it's just different. And those things flow through into how you manage your firm, how you think about the competitive landscape in which you compete, and how LPs need to think about building their portfolio for success over the next decade.
So as LPs see and hear the trends and how you're describing the challenges of getting back to a distribution yield that might work for them on a longer term basis, how do you recommend LPs go about thinking about their portfolios in this new environment?
The first thing you got to ask, it's the same killer question we ask GPs. When we ask GPs, what is your vision and what is your right to win? We ask the same thing to the LP. What are you trying to accomplish in your private markets portfolio? What is its role? What is your right to win as an LP? Right. So one of the things we've been telling the LP community is you need to scale with alpha generators, not with capital aggregators. They're very different things. You want to scale with alpha generators. So do you have a process and a set of tools that allow you to identify alpha generation? If the answer is yes, are you aggregating your exposure with the managers that are producing that alpha? And over time, those managers should have scarcity, access issues. We've been telling our limited partners, you have to be able to pitch those GPs on why you're the right partner for them. What are your unique capabilities that will allow a partnership together to not only help you succeed, but that GP succeed? What are your unique capabilities around call invest, around product support? Like, where can you lean in and help this GP? If you can articulate that, that's a differentiator. That'll stand out. You also have to start to build real-time active portfolio management capabilities. We think the asset class today is overvalued by about 10%, but that measurement moves a lot. And the liquidity of the asset class can come in and out rapidly. If you have a data-driven perspective on relative value and liquidity, and you have an information advantage on your own portfolio, you could be an active buyer and seller of your own book, whether it's fund positions or CV reactions. If you have those capabilities, you will be able to pick up nickels and dimes of excess return as an LP that other LPs won't be able to pick up. And with entry prices where they are, with macro prices where they are, every nickel and dime is going to matter over the next decade. And so those are the kinds of tools we're trying to build for our LPs and for ourselves. And we think those are going to be the keys to differentiation from the limited partners perspective.
On the way that fund flows have increasingly concentrated into the level 9 and 10 firms, a lot of that, there are a few channels, but the one you hear most about is private wealth. The classification you just articulated, alpha generators, asset aggregators, not necessarily mutually exclusive. I'd love to hear your thoughts on if all of this money is going into clearly asset aggregators. Perhaps they have alpha, perhaps they don't, as much as maybe some of the smaller, nichier players. What happens with all of this private wealth capital coming into the space over the next 5 or 10 years?
Man, you're trying to get me in trouble with somebody. There are really big firms that generate tremendous alpha. There are really big firms that have a couple of products that generate tremendous alpha. There are really big firms that have what we call these organizational competitive advantages, OCAs. There are some firms that have built firm-level OCAs. So it's not a talent thing. The firm has this machinery that creates alpha. And if you have firm-level OCAs that are transferable across strategies and across markets, you can be a high-conviction alpha generator across products, across industries, size strata, but it is rare. I bet only about a third of those level 9 and level 10 firms have that. The changes that are happening, unlocking the wealth channel and bringing more regulatory friendly product to the insurance channel, those are just packaging for the alpha and the beta. And then the question is, what is the cost of delivering the package, right? So if a scale manager who has broad-based alpha generation can put that into a package that is digestible and accessible by the wealth channel with a cost structure that leaves some of that alpha with the client, that's an incredible thing. That will help solve a lot of the actuarial challenges and the demographic challenges that we have, especially in the US retirement system. If the packaging costs more than the alpha, then we're just selling people a bunch of really expensive beta, and that's not good. And so I think some firms are going to do a really great job helping bring some of the benefits of this asset class to a much broader part of the investment community. And I think some firms are going to provide expensive beta. It's already happened. And it's that simple. What is your right to win? How do you quantify that in alpha? And is the wrapper and the delivery mechanism leaving enough of that for the client to justify the illiquidity? That's it.
As you're looking at this landscape and building these tools, I'd love to talk to you about your most recent initiative the last couple of years. You mentioned Keystone, but the strategy of how you're trying to serve this marketplace with an investment product.
I said at the beginning of this conversation, this is a lonely job running these firms. It's challenging, and it's a funny thing. Most founders have great investment talent, and they leave a big organization to start a business, which is a very different thing than being a great investor. Those are very different skills. And some founders are excellent at both. Some of them are excellent one, not the other. But the higher you get in the leveling framework, the leadership that is required, the skills that are required, they become significant. And as the steward of your organization, you have an obligation to all of your stakeholders to make sure that you can compete and defend your right to win, let alone expand your right to win. You have to bring it every day if you want to win. And the Keystone strategy is all about locking arms with the entrepreneur along that journey. All we care about is the most important thing to that leadership team. It could be an opportunity, it could be a constraint, it could be a challenge. Whatever is the most important thing to them is what we care about. And we want to break it down with them and help them come to the right answer for their firm, aligned with their goals and their stakeholders. If there is a way for us to put capital behind that solution that accelerates it, increases the probability of success, that's a Keystone deal. If we can put capital behind a great manager who is an alpha generator, who is trying to unlock something really, really important that will impact their firm, their people, their portfolio, their clients, that's a really cool project for us to jump in and learn about, right? And if we can help that firm unlock, guess what? If they're a level 7 firm, there are 600 other level 7 firms, and they're all probably starting to think about the same challenge, or some subset of them are. And like I said, if we can help that level 7 firm and we learn from it, that positions us to be a better thought partner for other level 7 firms who might be coming up to the same opportunity or constraint in 6 to 12 months. And so we have this very flexible, call it like special situation strategy that just serves sponsors. And there's really nothing like it. It is GP innovation. That's what it is. It's helping great firms do great things. The keystone species is the species in an ecosystem that helps the rest of the ecosystem thrive. And that's what our team tries to do every day, is help great firms thrive. Because if they're thriving, all of their stakeholders will benefit from it.
What are some of the examples of what that most important thing has been in some of the partners that you've worked with?
Right now, some of the themes that are very common, and they are derivatives of the themes, they're consequences of the themes, right? How do I think about consolidation? Should I be thinking about acquiring other firms? Or should I be thinking about partnering with, maybe I'm a level 7 firm, and I've either got to become level 9 fast, or I've got to partner with a level 9 firm. So thinking about consolidation and how you should play it is a big work stream in our pipeline today. Helping firms build their balance sheets so that they can continue to grow their firm and make big commitments to their funds in spite of the distribution slowdown is really important. Helping firms think about their right to win around new products. Should I launch a CV fund in my strategy? Should I launch a back to basic small cap fund? Should I launch a special sit? Well, maybe. Let's start with, are you any good at those things? We take them through the software, right? And then we unpack, why are you good at the things that you're good at? And if what you're trying to do is create opportunity for a subset of your talent to keep them here and keep them hungry and keep them motivated, here is the thing that the math implies you are great at, that we know LPs are looking for. This is the thing you should do. And then how do we help you finance that growth and increase the probability of success? Another big theme is, how do I do all of these things without selling permanent equity? If you're a great firm and you want to change in some way, your options today are sell equity forever or take on a loan. That's it. And I'm not sure putting a loan on a firm that does leveraged buyout is an incredibly stabilizing thing. It's probably not a good idea. Unless you're huge, right? If you're level 9, level 10, or even some of the biggest level 8s, you have a balance sheet. You're either public or you're quasi-public, and you get covered and served by the entire ecosystem of consultants, lawyers, and investment banks, right? It's the next 800 firms that are not well served. And so if we can help you finance innovation and change in your organization in a non-permanent way, that's powerful. It's more aligning with your investors, more aligning intergenerationally with your team. And another part of our pipeline today is helping firms that have sold permanent equity buy it back. We just helped Hayfin, one of the largest private credit managers in Europe, buy 60% of their firm back from a big pension fund. And so now, for the first time ever, management has a path to owning the vast majority of their business because of our partnership together. But helping the next gen of the firm buy back that 10% that was sold in mistakes trade 7 years ago, bringing that equity back into the firm, creating generational ownership transition machinery that kind of self-finances. Those are the themes of the pipeline and the conversations today, helping great firms navigate this pretty unique landscape.
In some of that generational transfer of equity, there have been some successful, kind of called succession to the next generation, and others that have been much less successful. What are the sort of parts of the ruler or the toolkit that you've seen that have led to more successful transitions?
That is a hard one to generalize. One of the things that's interesting is, and we've got a little research project going on this right now. First of all, how do you measure successful transition? Right? That in and of itself is kind of hard, right? One of the things that we have found in the data is that there is more stability in performance or durability in a firm's path along the leveling framework, depending on how founder-centric the firm is. If your name is on the door, it's hard, right? If your firm started as a spin-out from a big financial institution, which is actually quite common in Europe, it's less common in the US, but in a spin-out, there's less of a founder mentality. There's a stewardship, like a shepherding mentality. If the firm started with that architecture, the generational transitions tend to be a lot more seamless and stable compared to firms that are founder-centric. There is a way to measure founder centrality mathematically. You basically have to scrape tons of LinkedIn data. It's one way to do it. We, a long time ago, supported some really cool academic research on using network dominance to predict venture fund performance. It was actually better than quartiles. And so you could actually measure how important and how connected someone was mathematically through their connectedness on LinkedIn. And a firm, especially a venture firm, is really just a collection of the leaders' networks. And so you could measure if the aggregate network of the firm was growing in influence and importance, or if it was eroding. And for firms that were managing the generational transition well, their ascending partners were growing at a rate of importance that exceeded the decay of the setting partners' network erosion. So that's one way to mathematically think about it. But then you also have to have the economics transitioning in an elegant way. And it's hard. It's really hard. We have the benefit of having gone through it a few times ourselves. And we have the benefit of being entrepreneurs and firm builders ourselves. And that gives us a lot of credibility in the room with the leaders of other firms.
As you're doing all this research and trying to share it with the industry, there are only a certain number of firms that you're working with, either LPs of your products, strategies, or a couple of GPs in Keystone. How can other people glean the benefit of the insights that you're creating?
Well, we actually have a business unit here called Arctos Insights. And Insights pushes out really valuable content through a couple of different mediums. We have a couple of kind of closed research kind of newsletters where we send out information that serves decision makers in private markets and serves decision makers in sports. Those are the two sectors that where we try to be servant leaders. But Arctos Insights is the data science business that we run to serve the decision makers in the industries that we participate in. And so if people are interested in being a part of that distribution outreach, they just have to ping us and let us know. That's all. I mean, we can put that in the news, in your email.
So you've got the sports business. You started with Doc 5 years ago. You've got this working with practitioners in the space. How are you seeing these two collide?
I wish I could say we were smart enough to anticipate this, but it's been a beautiful, emergent property of the last 5 years. If you look at the people who have purchased control of North American sports teams over the last decade, 80% of them come from tech or private markets. It's because they're business builders. They have a sophisticated institutional grade mentality on change and the value of change, but they also have lots of ordinary income. And the sports properties create a huge tax shield. They are not correlated with healthcare or tech or finance. You're not allowed to use a lot of leverage. So if you are a titan of private markets, you have a lot of levered exposure to all kinds of equity, and you have a lot of ordinary income. And no matter if you've moved to Texas or Florida or Wyoming, you still don't like paying a big chunk of it out. And so there is a really unique benefit to being a direct sports owner if you are coming from the finance industry. And so from time to time, we have the opportunity to help leaders of private markets firms become owners of sports assets. It also helps that we've served these masters of the universe our whole career, because the masters of the universe in sports, some of them are the same people, right? And so there's actually a really unique overlap between our Keystone business and our sports business, in that some of the leaders of both industries are the same. Look at Josh Harris and David Blitzer and Ostrover and Arrighetti. I mean, the Rubenstein now, it's a pretty impressive list.
So when you bring this all together in your framework, at which level does Arctos sit today, and where are you hoping to take the firm over time?
Today, Arctos is what I call a skinny level 7. We're hanging on by our fingernails to level 7. And we were, in our data set, the fastest firm to reach level 6. Josh Harris started 26 North. But Josh and his team have done an incredible job building that thing. And so more than happy to relinquish that first to level 6 title to Josh. Our goal has been the same the entire time we've been building this place. It was a beautiful part of our origin story really early on. The founders got together and instead of doing the things that founders want to do, find the office space, finalize the logo, pick the name, all the kind of things you feel like you have to do. We paused for a couple of days and did some really hard work to figure out what are the core values that we want to instill in this thing we're going to build together. And how are we going to define our vision? And the way that we do that is with what we call our passion and our niche. Passion is we want to disrupt and innovate the markets that we serve. And our niche is how we do that. And we do that by solving complex problems with creative solutions. So what we want to do is disrupt and innovate the markets that we serve by solving complex problems with creative solutions. And we do that in sports, and we do that in private markets. And we have a right to win, and we know how to articulate that right to win, that alpha equation, very clearly. And then as an investment committee, we make sure that that alpha equation is demonstrable in everything that we do. And then we just try to delight the client. That's it. And where that takes us, level 8, level 6, level 1, I don't know. But I know that this has been an incredible journey. I'm grateful for the journey. And the journey allows us to serve other sponsors better. Being entrepreneurs and being founders allows us to serve founders better.
Right, Ian, I want to ask you a couple of different closing questions than you've heard before.
Okay.
So we'll run through them.
It makes me nervous. I'm a little nervous about this, but okay.
What was your first paid job?
My first paid job was working construction in my hometown in Alaska. The construction industry in Alaska is very seasonal. You've got to get it done in the summer. And so if you're a punk kid and you can carry plywood around, you can make a lot of cash. But all my buddies blew their cash on beer. And I realized there was nothing illegal about me learning how to brew beer. So I befriended the local owner of our homebrew store. And I started brewing beer and selling that to my buddies in the winter. That was my first paying job that I enjoyed. My first real entrepreneurial thing.
How's your life turned out differently from how you expected it to?
I thought I was going to be a physics teacher. I knew I wasn't smart enough to be a physicist that mattered, but I love physics. So I thought I would just be a physics teacher and have a beautiful family with my incredible wife. And we're both from the same small town in Alaska. And when you're from that town, you don't know what's possible. And what's one of the things I'm so grateful for is I've got that incredible partner. We've got this beautiful family. And I figured out in undergrad, I wasn't going to make very much teaching physics. And the math in macro was a lot easier than the math in nuclear physics. And so the thing that has surprised me is how much this industry has impacted our lives. And I'm grateful for this industry. I want to find ways to serve this industry for the rest of my life. And that's to know that I've got that passion and that's something that I can do for a very long time is an unexpected gift along this journey and something I'm really excited about.
What's a mystery that you wonder about?
I spend more time than I probably want to admit trying to understand the most complex parts of cutting edge physics today. So things like gravity loops and how time actually changes quite a bit depending on where you are, how fast you're going, and how strong gravity is. And so I would love to understand the things that happen right on the edge of a black hole. That's where things get crazy. And that's where some of the smartest people in the science world are focused today is on quantum loop gravity and how general relativity and sort of Einstein's physics connects with quantum mechanics. That harmonizes somewhere right on the surface of a black hole, and nobody understands it. I would love to understand that. That'd be pretty awesome.
All right, Ian, last one. If the next 5 years are a chapter in your life, what's that chapter about?
It's about appreciating I might be in the best phase of my life. I love what I get to do professionally. My family is thriving and healthy. And I know that it's rare for all those things to be harmonized in a positive way. And I hope and pray that they stay harmonized over the next 5 years. And I hope that the next 5 years is about me appreciating that and being grateful for that and bringing gratitude every day. I hope that's how it turns out.
Ian, thanks again for sharing your incredible insights and efforts to service this community.
Listen, I always enjoy it. I hope the audience enjoys it, and I appreciate the opportunity very much. So thank you.